Welcome to Sectors Up Close. I'm Elena Casas. Today we're talking about communication services and my guest is John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management. This S&P sector is of course dominated by big tech. It has three of the so-called Magnificent Seven: Alphabet, Meta and Netflix. Last week, Meta's shares soared after the company announced its first ever dividend, following a 25% jump in quarterly revenue. But perhaps the company's biggest competitor for online eyeballs, Alphabet, was punished by investors after ad revenue missed expectations. Both companies are spending heavily on artificial intelligence, hoping that will boost the bottom line. Well, I'm joined now by John Stoltzfus of Oppenheimer Asset Management. John, hi. As I said there, we saw a mixed bag of results from the big tech companies here last week. What did you make of that?
Well, I think when it comes to that mixed bag, I think it's not uncommon at a stage where we are with AI. AI has been around in a primitive kind of basis as we know it today. When we dial up a credit card issuer or an insurance company or a discount brokerage or something like that, and you get the voice and it responds to your inquiries and tries to put you in certain buckets. But this stuff that's happening, and it's already on the factory floor, and the consumer has access now to it in the first generation that we're really seeing available on some of the search engines. What happens is very natural. Is at this stage, earnings can be mixed to disappointing to extremely surprising on the positive side on a quarter-to-quarter basis. It requires patience. It creates opportunity for traders to go in and out, and for intermediate to longer-term investors who can withstand the volatility that can happen in these sectors. An excellent, we think, opportunity to consider for diversification and setting a portfolio on track for the world as it develops.
What about the question, John, of regulation? Also last week, along with those earnings, Mark Zuckerberg and other social media CEOs were hauled in front of a congressional committee which accused them of failing to protect children. Do you think investors should be worried about regulation changing the way they operate?
I think it's important to consider the need for regulation in the space, not over-regulation, and certainly not grandstanding by politicians in televised hearings, but for responsible thinking about how this stuff connects with the consumer and with the youth in particular, but with everybody. With an election year coming up stateside, we've already seen potential problems related just in the last week, in terms of impersonating one candidate. But it's not uncommon. We've had it. Regulation was required with railroads, with canals, with early technology, with the internet, and so we'll be here. I think the most important thing is avoid over-regulation, and the political grandstanding always a difficult thing to do because everything is televised. And, it's like the British group, the Kinks, used to say, everybody's a dreamer, everybody's a star. They saw it years ago going to happen.
Talking of everything being televised, another big question in this sector recently has been the streaming wars. Last week, Netflix announced its biggest fourth quarter numbers for subscribers. Has those streaming wars been won? Is there a clear winner in a space where we've seen a huge amount of competition?
Yeah, well, Elena, when it comes to streaming, it really is, it will be interesting to see how it actually continues to unfold going forward, and to see, the cost of content, the competition in terms of attracting eyeballs sounds a little bit like the tech bubble, doesn't it, when it happens? But today it's involving much larger companies, a much more sophisticated listener or customer or viewer, let's put it that way. And it's all in a process of transition, which makes the streaming element important for investors to consider, to know the difference between established stars in terms of the companies, they're profitable in that area, and those that are still have longer duration, so to speak, or longer time before they become major accepted companies or not.
A number of the big tech and media companies in this space have made significant layoffs in recent months. John, is that sensible right sizing, or is it a possible sign of danger ahead?
We would think right-sized downsizing, and we've even seen one particular, actually more than a few particular names, when they announced the cost containment effort to be rewarded by traders on intraday or intraday trading. Cost containment always an important thing, and also important to realize that where we've come from during the pandemic and coming out of it, there was a lot of demand by many companies, and many companies warehoused employees. And as a result of that, they're now culling employees who they hired too many people. The good news is within the community, the tech community is fairly fluid, and it's a dynamic story, and there are other opportunities. And we like to think if somebody's laid off in tech and they're real good, what if they go to another sector? How will that help that sector? What will they do to that to connect to this huge thing that is happening?
John Stoltzfus of Oppenheimer Asset Management, thanks so much for that insight. And that's your roundup of the communications services sector. I'm Elena Casas, and this is Reuters.